Gold is supposed to be the asset investors buy when the world becomes more dangerous. Yet, on Thursday, July 23rd, gold dropped more than 2%, even as Middle East tensions pushed Brent crude to $100 a barrel. That did not mean gold had suddenly stopped being a safe haven. It meant the market was pricing another force even faster: the inflation, interest rate, and dollar shock created by higher oil prices. The mechanism starts with energy. When oil jumps, investors worry that inflation could stay elevated for longer, which makes the Federal Reserve less comfortable cutting rates and can revive expectations of future hikes. Bond traders responded by selling Treasuries, lifting the official U.S. 10-year yield from 4.55% on July 17th to 4.71% on July 23rd, before it eased only slightly to 4.69% on Friday. The dollar also strengthened as gold fell, adding another headwind because dollar-priced bullion becomes more expensive for buyers using other currencies. This is the hidden contradiction behind the move. Geopolitical danger can increase demand for gold, but an inflationary geopolitical shock can simultaneously push yields and the dollar higher, increasing the opportunity cost of holding an asset that pays no income. The World Gold Council describes gold as being driven by several forces at once, including risk and uncertainty, opportunity cost, economic conditions, and market momentum. On Thursday, the opportunity cost channel appears to have overpowered the immediate fear trade. That reaction matters more than the headline alone. If conflict risk remains elevated but gold still struggles while Treasury yields and the dollar stay firm, the market is telling us that inflation and monetary policy remain the dominant forces. Confirmation would be gold failing to recover as yields stay near recent highs and the Fed maintains a restrictive tone. Invalidation would be gold rebounding decisively despite elevated yields or oil and rate expectations falling enough to remove the pressure. The next major test is the Federal Reserve meeting on July 28th and 29th. The policy decision is scheduled for Wednesday, July 29th at 2:00 p.m. Eastern Time, followed by the press conference at 2:30 p.m. Eastern. Reuters reported that traders still expected no change at that meeting, even as the implied probability of a September rate hike jumped to about 83% during Thursday's session. That probability is a market estimate, not a promise of what the Fed will do. The calm verdict is not that gold has lost its safe haven role. The message is that gold does not trade on fear alone, especially when the same crisis also threatens higher inflation, higher yields, and a stronger dollar. In this environment, the most important signal is not simply whether geopolitical risk is rising. It is whether safe haven demand can become strong enough to overpower the yield shock standing in its way.